Now, I'm going to go over this unit a little bit differently than going page by page. The Real Estate Commission sends the instructors a syllabus, and they would like the instructors to follow the syllabus the way the commission would like for us to handle the lecture. That sounds a little redundant. But the first thing we're going to talk about in Unit 15 would be the loan types. And it is a level 2, so let's make sure we're good on that. When we get into the USDA type of loans, that's level 1. When we get into the repayment plans, we'll refresher back to Unit 14 and talk about that, which is Unit 1. And when we talk about the U.S. money policy, that's about the Federal Reserve, level 1. Primary market, level 1. Secondary market, level 1. So at the beginning of the unit, I hope you didn't get too bogged down on worrying about the secondary market of Fannie Mae and Freddie Mac. Guys, we're just going to talk about it on a basic level 1. Basic level 1. Is everybody pretty good on that? And we'll see how we get. I may stop before the truth in lending. Your lecture on Wednesday is the beginning of the closing lecture, which is Unit 21. And in the closing lecture, there's discussion about how closings are handled now, and it does bring up truth in lending again. And so that all goes together, so that merges well. So we may stop there before the truth in lending today. And the only math we're going to do is qualifying the buyer, and it's the T-bar, everybody. How many of you are using the T-bar or trying to get used to it? Or are you just doing it your way, not the T-bar? Most of you doing that? T-bar, huh?
I just haven't learned it completely, so I go my way, I guess.
Your way's fine. Your way's fine. I just would ask you, if you're not using some sort of a formula, I would really try to use some sort of a formula, because it will save you time. In other words, what I'm saying is up to you how you want to solve your math problem. But if you don't have an idea of where to start and you're working your answers backwards until you find the right answer, that's going to take a lot of time. And time is, well, time's not money, but we could say that, couldn't we? So you do want to pace yourself. So try to practice on the T-bar if you don't have another way. And so another reminder, I'll be in Chapel Hill on Wednesday for an instructor meeting, but Chris Heffer will be here to give you your lecture, the beginning lecture of closing. I will be here Thursday to pick that up and conclude it. So any questions that you would have, we can handle it Thursday. Is everybody good? We'll be doing a whole bunch of math on Thursday with the closing math, the proration, and that sort of thing. Okay then. And one thing, I'm going to look at my calendar. If anybody feels like they need any help with math or anything, I'll look at my calendar over the next couple of weeks and see if I have a Wednesday or a Thursday that I can hang around after class for a little bit if anybody wants to hang around and wait. So I'll just have to look at my calendar and see what I got. Would anybody be interested in that? Okay. Math or other? Math is usually what I hear. Okay, so I'll look at my calendar. Alrighty, so let's go to Unit 15. Real estate financing, and we're going to look at the loan types first. Remember I said this is the way the order of discussion is going to be. So page 432. So most of you want to come on Tuesday the 23rd, right? Okay. That makes sense, because that's getting close to the end there. All righty, so let's talk about loan types. Guys, there are three main loan types: conventional loans, FHA loans, and VA loans. Can you tell me, just with that opening statement, can you think of a difference between those three loans? A difference or two?
VA is mainly for veterans, kind of thing.
VA is, well, Jose said mainly for veterans. That's an interesting word to say, mainly. Why'd you say mainly?
If I remember right, it's also the relatives can benefit.
Well, not relatives, unwed widow or widowers. So I like the way you said mainly, because it is a veteran benefit, but that veteran benefit would flow to the unmarried widow or widowers of the veteran, not other family members that I'm aware of.
When I was in, they said that you could transfer it to your children.
Oh, the loan? Okay, well, that's not in our reading. I'm not sure about it. So it said and things have changed, I'm sure. So I believe you, but it's not in our reading.
The financing?
Uh-huh.
Like the difference between the loans, that I guess, not right?
Yes, you are right. She said the type. Conventional FHA, VA, the type of financing is different, meaning what? What are we getting at there?
The way they're backed.
The way they're backed. And how much can you borrow? So you're right about that. The whole programs are different. Uh-huh.
With the FHA loan, the government is responding to lack of housing with FHA loans.
FHA loans came about, Latoya said. Very good, everybody. Latoya said FHA was a response by the government because of the economy being so bad after the Great Depression. So FHA loans came about in the early 30s, didn't they? To stimulate the economy. Golly, we hear that now, those words, don't we? How are we going to stimulate the economy? And we heard it a lot during the financial crisis. But way back then, after the Great Depression, FHA loans came about. Someone said, then how are they backed? So let's address that for a minute. Are conventional loans backed by the government?
No.
No. So I would remember that. Good test question. Which of the following loans are backed by the government? That word backed could mean insured or guaranteed. So why don't you write that down? If you get a question and they say, which of the loans are backed by the government? Well, FHA loans are insured by the government. VA loans are guaranteed by the government. And so be careful about that. That's a relatively straightforward statement, but students tend to get confused with insured and guaranteed. And what's the difference? Well, here's one difference. An insured loan has insurance payments with it. So an insured loan would have, on an FHA loan, what they call mortgage insurance premium. So here's what the payment would be for an FHA loan. It would be the principal and interest, taxes and insurance, and then what they call mortgage insurance premium. So an FHA loan will be escrowed. Does everybody follow me on what escrowed means? Escrowed means the lender's collecting 1/12 of the monthly homeowner's insurance, 1/12 of the monthly taxes, and 1/12 of the FHA annual mortgage insurance. So that would be how an FHA loan payment would be.
And the mortgage insurance on that loan is for the life of the loan, right?
The mortgage insurance for that loan would be for the life of the loan, correct? Versus what? What are you talking about, Jose?
Huh?
Where does that question come from?
Oh, because if I remember on the conventional loan, if you finance it with 80%, you have to pay the mortgage insurance, but after you pay it down to 80%, they will pretty much take it off.
After it goes down to 78%. Jose's remembering in his reading, and good job. Jose's remembering when he asked that question, is this for the life of the loan? Made me think he knows something else. And so he did. He says, but conventional loans, if someone borrows for a conventional loan and they don't put down at least 20%, the lender's going to say, this is risky to us. We're investors and it's risky, and we want you to get some other insurance. Mortgage insurance is what it's called. Actually, let's call it private mortgage insurance. So a conventional loan, let's put FHA. If the loan is conventional and it is an insured loan, that's what the payment would look like. Principal, interest, tax and insurance, and private mortgage insurance. Conventional loans are not governmentally insured. It would be a private mortgage insurance company. Yes, it functions about the same as FHA insurance, with one exception. Jose said, when this LTV, what does LTV mean? Loan to value. When the loan gets down to 78% of the value of the property, then that means that if everything else is looking pretty good, this insurance is supposed to automatically drop. FHA stays on the loan, okay? And this would drop after the loan value gets below 78%. Always, everybody, even always, if you borrowed money, if you went to the bank and said, I want to get a conventional loan and I do not have 20% down payment, the lender would, if you qualified, would give you an insured conventional loan. Any time over time, you could always call that lender and say, I think my property has gone up in value enough that the difference there is more than 20%. In other words, everybody, we're talking about equity. Think about equity. Equity is what you've got accumulating in the property. It's the value of your property minus your loan amount. Equity is value of your property minus your loan amount. Doesn't your value go up over time, hopefully? Real estate is a long-term investment, and your loan tends to go down even though it's a slow amount. So if your value's going up and your loan's going down, you're building equity. And if the market is really good, the value could go up quicker, and you could be building that extra equity in there that the lender might say, we feel safe now, we'll agree to drop the private mortgage insurance. But in order for them to do that, they would have to verify that the value is there, and they would ask you, if you wanted them to consider this, they would hire an appraisal, and you would have to pay for the appraisal. Now, these mortgage insurance premiums, everybody, and your payment are not cheap. And so it may be worth it to say, please hire an appraiser. We think that we've got value, and we would like to ask you to drop that private mortgage insurance. So that a consumer can always do that. And it's because of how equity works. Now, equity could work another way. Couldn't the loan stay the same and the value go up? Couldn't the value stay the same and the loan go down? I mean, there are lots of ways for equity to grow. Couldn't you be paying more on your principal? That's growing equity, isn't it? And so it could change a different way. Alrighty, so conventional loans are not backed by the government. We said FHA loans are insured by the government. There's that mortgage insurance premium. Let's talk about VA for a minute. Since we've got this up here, a VA loan is not an insured loan. So a VA loan will not have mortgage insurance. What do VA loans require that these other loans don't require? It's an upfront fee. What's it called?
Origination?
Not originate. They will have that. All loans do. or let's say most loans, what would you, it's called a funding fee, everybody. On a VA loan, the lender's going to charge a funding fee that would go in the reserves or into the kitty, if you want to say it that way, for any kind of loans that default where the lender has to guarantee to the lender. In other words, there's not a mortgage insurance premium, there's a funding fee. The funding fee depends on the veteran's eligibility, and because it's going to depend on that veteran's level of guarantee. And so it's a one-time upfront fee and not in the payment. It's just a one-time fee that the lender collects that would go into a reserve or some kind of an account for the bank that covers any kind of defaults and deficiencies. So in other words, if the veteran were to default on the loan and the lender takes them to foreclosure and there's a deficit, this is a guaranteed loan. The lender's going to be paid. They're going to get their money because of this guarantee and because of the funding fees that are collected by everybody on every VA loan, let's say. Alrighty, so good start. Let's go to page 432 then. So conventional loans, it says in your first sentence, not backed, not insured, not guaranteed, not backed by the government. So conventional loans are made by banks, and in your reading it gave you some places where people get loans. That would be called the primary market, wouldn't it? Where you and I go to seek our loan. So they're not backed by the government. They're loans that are, sometimes you hear these loans called conforming loans. They go to certain standards. Maybe we could even say Fannie Mae, Freddie Mac guidelines. Remember we talked just briefly about lenders like to bundle up the loans, these accounts receivable and bundle up so they can take them to the secondary market to sell. Look with me under conventional loans where it says value is the sales price. Now we talked about this one other time, didn't we? We talked about LTV, I believe that came up in Unit 14. LTV, the value is the sales price or the appraised value, whichever is less. I would highlight that sentence. I'm in the VIP paragraph. Value is the appraised value or sales price, whichever is less. Does that make sense? When we talk about lenders lending money, the lenders want to make sure that the consumer is qualified for the loan. They're going to run them through the qualifying process. One thing is to look at their credit score, big thing. Look at their credit score, look at their income, look at their debt, and look at their property. And even if a buyer is willing to pay a certain price, if the appraiser says it's not worth that, lender, it's not worth it to you, lender, to lend on that price. Didn't we say that the buyer can always pay more if they want to? It's just going to be the lender saying we don't want to lend on that though. So they'll lend on the lower of the two, the sales price or the appraised value. Conforming loans, 1 to 4 family unit, and generally there's going to be some sort of a maximum payment maybe, like, or let's say minimum payment, at least 5%. I don't know that conventional loans lend any more than 95%. 95% is a whole lot, isn't it? The lender lending 95%, they've got 95% risk. Generally speaking, the consumer's got to put down something, and so 5%. Now, if you compare that to FHA and VA, FHA loans are less down payment than that. FHA loans require 3.5% down payment. So you can even see that's even riskier, isn't it? But with the mortgage insurance premium, not so risky. And then VA loans can be 100% loans. Alrighty, so we talked about the private mortgage insurance called PMI, private mortgage insurance. Now, if buyers and sellers negotiate, remember when we looked at our sales contract, Form 2T, we said that the buyer could ask the seller to pay closing costs. Well, there's going to be a limit on how much the seller can pay. Why do you think that would be? Your reading says up to 6%. To me, that sounds like a lot of money to ask the seller to pay, but why would the lender say there's a limit on that? In other words, seller, you just can't pay any amount up to about 6%. Now say that again.
Is it because they want to make, is it the yield that they want to make, so they won't make as much interest off of it if you pay it?
Well, I understand Yadira's saying, is it because the lender's not going to make interest? I understand your thinking because they are looking at money, but this is going to be a down payment or closing cost no matter what. And so what we're saying is, instead of the buyer paying it, ask the seller to pay it. And the lender says, this amount of money has to be paid by somebody, but we're not going to let the seller pay more than 6% of it. So it doesn't have anything to do with the loan that the lender's making money on.
I think they want the buyer to be more invested into the property, to have more skin in the game. Yep.
Did you hear Kate? Let's have her talk some more. Go ahead. Your accent's so sweet. But she said the buyer needs to have some skin in the game, the borrower, let's use the right word. The borrower needs to have something invested in it. If not, defaulting is nothing. You could argue, couldn't you? So they want the borrower to have something in it. You know, you put in some risk too, but the seller can agree to pay up to 6%. Now those closing costs, everybody, they do add up, to be honest with you. Typically speaking, closing costs might run 3.5% to 4% of the loan amount. But so that leaves a little bit. Maybe the buyer will say, seller, will you pay a point or two for me? Because I want my rate to be discounted. So if the seller pays that, they're paying interest on the buyer's loan. How about that? So I have heard sellers say, I'm not paying their interest on their loan. I'll be happy to pay part of their closing costs like lawyer fee, someone mentioned loan origination fee. I'll pay some of that. I'm not willing to pay their interest. Now, you could argue it's a moot point if you're paying money where it goes, but some people kind of get stuck on the principle of it. That's right. Non-conforming loans in your reading, they bring up jumbo loans. Jumbo loans are just larger loan amounts than the typical loan. Well, there's probably not a typical loan, but large loans amount, over a certain amount, 400,000, something like that. And other non-conforming loans would be what they call those subprime loans. What is a subprime loan?
No, severe credit individual.
It's what?
Higher risk.
Somebody with not severe credit.
Maybe somebody with not so good credit. What'd you say, Renee?
Higher risk.
A high-risk loan. I really think that subprime term is odd, don't you? It seems like an odd description, but not a prime. When you talk about prime, maybe that means really good. You know, prime consumer, prime applicant. Subprime, Jose said, is like somebody without a good credit score. And way back in the financial crisis, that's what happened. Lenders were making loans with folks that had credit scores in the 500s, low 500s. And it led to some problems. So some of the problems were the adjustable rate loans. You know, the adjustable rate mortgages where at the beginning of the loan, the interest rate is so low. I call it a little teaser rate. I mean, it's an interest rate they're going to be qualified on, but it's not really the market rate. It's below the market rate, and then when the rate adjusts, the lender's going to catch up on their profit when the rate adjusts. Alrighty, so on page 433, they're bringing up this private mortgage insurance. And so everyone, when you pay insurance, don't you get an annual bill? You get an annual bill on your homeowner's insurance or your car insurance, don't you? Now, car insurance you might pay monthly. I guess you could do that in your homeowner's insurance too. You would if you're escrowing. You know, they'd be collecting it monthly. So private mortgage insurance on a conventional loan would be collected monthly too. So when we talk about escrowing, even all of this, all of that would be 1/12 of the yearly bill. So 1/12 of the annual homeowner's insurance premium would be collected monthly to go into escrow. 1/12 of the yearly taxes would be collected monthly to go into escrow, and 1/12 of whatever insurance premium, depending on the type of loan, would be collected monthly to go into escrow. All righty. Did I tell you years ago when I was selling real estate, way years ago, in the 70s and 80s, buyers who would call and say, we want to go look at houses, we've already saved our 20% down payment. We would hear that often. The mindset was, we want some money saved up before we buy houses. And of course, the mindset has changed over the years, hasn't it? Lenders started making 100% loans, and they're giving you some information about that piggyback loan. Did you read over that, the piggyback loan, where you need at least 20% down payment so that you don't have to pay private mortgage insurance? But the lenders, depending on the value of the property, they're looking at what could be equity maybe, and they're looking at that value and they're saying, you know what? We can go ahead and give you an 80% loan, which would be uninsured, and we can give you an equity line of credit, 20%, and just lend you the whole thing, which basically is a 100% loan. And that's problematic, you know, especially when we had the financial crisis. All righty. FHA loans, LaToya said, they came about to stimulate housing because after the Great Depression, I'm at the bottom of 433, people were, well, number one, they didn't have money, did they? And so, and way back then, people didn't want to get into debt, everybody. But like I think I said to you one time, real estate is really a backbone of the economy. When real estate is doing well, lots of things are doing well. I was listening to the news this morning, they were talking about unemployment is the lowest it's been in forever, below 4%. Well, here's what they said. Contractors are busy. I forget what Ellie said, but contractors stuck to my mind. Contractors are busy. And if contractors are busy, well then stores like Home Depot and Lowe's are busy. Workers are busy. Paint stores are busy. Banks get busy. You know, it just kind of trickles down, and good thing. So that, back after the Depression, the idea was if we could stimulate the economy by encouraging people to buy houses with a little bit down payment, and then we'll insure those loans. That's how FHA came about. Go with me to the next page. FHA operates under HUD. And I would remember that FHA, look at your very important point, they don't build homes nor lend. So a good test question is, where would a consumer get an FHA loan? Banks. Guys, they would just go to a bank. They would go to a bank and get a conventional loan. They would go to a bank and ask for an FHA loan. By the way, lots of consumers don't know what kind of loan they want or what kind of a loan they would qualify for. And you as a real estate broker may have to kind of guide them a little bit, ask them questions. How much do you have saved up? Not much. If I don't have much, well then it might be an FHA type of loan that you're interested in. First-time buyers, second-time buyers tend to use FHA. It doesn't mean it has to be first or second-time buyers though. So FHA loans would be by approved lending institutions. It's an insured loan. FHA, the bank sets the rate. You know, students, and I understand this, we all get a little confused. Well, if it's an FHA loan, shouldn't it come from the government? Shouldn't the government set the interest rates or the discount points? No, the lender An approved lender who makes these loans will set the rate that they need. And they'll set, if they're discount points, how many points they need to have. I would look at my second VIP. Good test question: which FHA loan is the most common or the most sought after? And if you look at the 203B fixed interest rate, don't you agree that most people want a fixed interest rate? Most people want their loan payment to be the same every month. They don't like the uncertainty, the uncertainty of an adjustable rate mortgage. If the rate adjusts, well, then that means the payment will adjust. And so most folks don't like that. Look at your number 1 under FHA, second VIP. It says in addition to paying the interest, the borrower pays a one-time mortgage insurance premium. Now everybody, that one sentence, I think it clarifies it a little further in your reading, but that one sentence is a little misleading to me. It's a one-time upfront FHA insurance premium. So FHA insurance premium would be paid 1 year in advance upfront or financed in the loan. But after that, there's going to be like 1/12 every month collected in the payment. Let me give you a note here that will make sense when you get your lecture on closing and when you start reading Unit 21. All insurance is paid up front. All insurance is paid, let's say, at least a year in advance. The insurance company wants their money a year in advance. If you are getting homeowners insurance, they're going to require the first year to be paid in advance when you buy a house. FHA insurance, the first year in advance would be required. Conventional loan, they're going to be asking for that. What other kinds of insurance? Any kind of insurance is going to be required to be paid in advance. So when we do our closing math problems, the buyer will be charged the first year in advance on FHA or homeowners insurance. It's the lender wants their money in advance. And then after that, it's going to be 1/12 per month into the payment. Alrighty, so we know that the property would have to be appraised, and FHA appraisals are just a little bit stricter than maybe other appraisals are. Comments on that? Anybody got any experience in FHA appraisals? Anybody got an FHA loan? Yes, ma'am.
Yeah, I have. They're pretty strict with it.
Like, for example?
Just kind of like with the foundation, certain blocks under the foundation, we had to mortar those. They were just
Real strict.
Yeah,
It almost feels like, and it's not the same, VA appraisers too. It almost feels like they're doing a home inspection in a way. They're not doing a home inspection, like a home inspector would, but it almost resembles that in a way. It wouldn't be unusual for them to say, you need to paint the exterior trim. And it wouldn't be unusual for them to say, and the paint that's scraping, that's flaking or peeling needs to be scraped off, and any kind of paint droppings on the ground need to be picked up, and it needs to be painted back again. And by the way, it would have to be approved all along during the process to make sure it's done right. The thing about these repairs would be, oftentimes the buyer who is under contract with the seller doesn't have much money because low down payment for FHA, and if the appraisal comes in and says these repairs to be made, it's going to fall on the seller more than likely. And if a seller really needs to sell their property, they may be prone to do those repairs. If you meet an owner who says we don't have extra money to pay for these repairs, well then an FHA loan might not be something they should accept on an offer from a buyer. Does all that make sense? When you all looked at your listing agreement, didn't it say, seller, which of the types of financings would you agree to? And so you're going to check off, would you agree to FHA, VA, conventional, owner financing? All of those, that was on your listing agreement. about that. And didn't we talk about the offer to purchase? The buyer needs to disclose to the seller what kind of loan they're going to be getting. That would be important to the seller. If there are lots of repairs that need to be made and the seller says, I don't have the money to make those repairs, probably the buyer doesn't have the money to make those repairs either. And that loan might not be one that would work. All righty. FHA loans are for residential, everybody, not for investment. Residential, by definition, is 1 to 4 family dwelling. 1 to 4 family dwelling means a single family dwelling, a duplex, a triplex, or a quadruplex. Over 4 is not considered residential. FHA loans are prepayable without penalty. Most loans are prepayable without penalty. Think about it. We talked about a loan could be shortened by someone sending in $100 extra a month, you know, paying down the equity. If you're sending in $100 extra a month toward the principal of the loan, then technically that's prepaying, isn't it? And if your loan had a prepayment penalty, that would be 1 step forward, 2 steps back. I mean, it wouldn't be good. Most loans don't have prepayment penalties, but if it did, the lender would advise, and so would the closing attorney. Look at the other types of FHA loans and loan assumptions. Now, we talked about the loan assumptions only if the buyer qualifies, right? That was after loans of 88 or 89. If it was a loan before then, gosh, that's 30 years, guys. It'd be paid off by now, wouldn't it? I mean, it wouldn't be even available for loan assumption. Look at the other programs. There are improvement loans. There are condominium loans. Look at your Title II, Section 234. Is that interesting to you? Why would they say we have a condominium loan? Isn't a condominium a residential property? I mean, could be. Huh? What do you mean, Kristen? You're on the right path. You're on the right path. Kristen said, don't you normally rent condos? Who normally rents them?
The beach.
Oh, at the beach. She's on the right path. Condominiums oftentimes are purchased by investors. And an investor is purchasing a condo, certain price points, they're going to put renters in there, aren't they? And the lender wants to be protected because this is investment for them. They're putting out a lot of money for this investment. They're letting the consumer borrow. They may ask how many properties in that development are rental. They may want to know how many rentals are in that condominium development. And then they might ask this question. Excuse me. They might ask how many of those rentals are owned by the same investor. Why are those important questions? Why would the lender want to know how many rentals are in this development that you're asking us to lend you money on?
Because wouldn't it be a separate for each rental person, like a separate fee or interest,
Well, each one's going to have a separate loan.
Because wouldn't that add up if it was more renters versus one?
More renters versus more owners leads to what? Might bring down the value because of maintenance issues, default issues, where the renter doesn't pay. And then what if the investor gets into trouble? Maybe they've got multiple rentals units there and they had multiple renters breaking the lease, and then how do they make any payments if there are loans on it, right? And so it could be risky. There are graduated payment mortgage and there are adjustable rate mortgage payment plans under FHA. The graduated payment plan, everybody, is sometimes called the step-up plan. Graduated, you gradually get to the payment as the borrower that the payment should have been when you went for the loan. In other words, you go in to apply for this loan, this FHA program. What the payment should be, this borrower can't qualify for right now. And the lender says, we've got this program that we can start your payment lower And next year it'll go up a little more. Next year is 5-year step up until we get you to the payment that it's supposed to be. Well, now think about that for a minute. If the lender's not getting the payments that are due the lender, what do you think is going to happen to the loan? Is it going down? No, it's going up. Guys, let's remind ourselves what amortize means. Amortization means the loan balance is going down. It's a systematic repayment of the debt. If you're not making the payment you're supposed to make, the debt's not going down. The debt will be going up a little bit, everybody. It's referred to as negative amortization. Now, you might ask, who in the world would do that? Well, I can tell you who in the world. It was a very popular program before the market crashed. Very. Lots of buyers getting into this kind of a loan because the idea was this. The market is going to increase the value of your home, and the odds of you in your job getting raises over time, this will work itself out. Even if the loan balance is going up a little, your value's going up probably a lot. Lots of people got those loans back in the day, everybody. Now today, I don't know so much.
Yeah, wasn't that referred to like the balloon loan or balloon type loan?
Well, there are balloon payment loans. I don't know if, I mean, it could have been on that loan. But the big thing about it is the loan balance is going up instead of down. And it's called negative amortization. Guys, if you understand what amortization means, going down, negative amortization is going up, even though the word negative is confusing. The balance is going up instead of down. I don't know that these are popular loans now because the market's not like it used to be. And so I would think maybe not so much.
I'm thinking even now it could be good for people who flip the houses. They know that they'll sell the house in a year or two, so.
Kate said, I think this would be good for people who flip houses. There's just one flaw with that statement. This is not an investment loan. Now, if someone bought it to live in and said, I'm going to live here for a year or two and then do that, perhaps, that thought is interesting. But does everybody understand FHA is not going to make investor loans? It doesn't mean that you can't buy a house for your primary residence and live in it and have a game plan. We're not going to live here all that long, but we are living here. It's our primary. And with the idea, we're going to do something. So you're not way off on that. That could be the idea too. But getting an investment loan on FHA would not be. And then adjustable rate loans. Adjustable rate is just what we said. The rate will change periodically. Now, it doesn't change every month, everybody. Did you read your payment plans in Unit 14? The adjustable rate payment plan could be a 1-year adjustable. It could be a 3-year adjustable payment plan or a 5-year adjustable. Now, you might even wonder who would want that, and I'm going to say probably lots of people would want that because the beginning rate is really low, and then the rules are part of the contractual information in that promissory note or deed of trust would be something like that rate can only go up maybe 1% each adjustment. It can't go from 2% to 6% when in one adjustment. There are limits on how much it can change, and then there are limits on how much it can change over the entire life of the loan. And when I say change, I mean go up or go down. It can only go up so much each adjustment or go down so much.
You can always refinance too if the rates are looking good and all of a sudden yours is going up.
That's exactly correct.
Is there a max out on that?
Max out on what?
Like the adjustable rate, so if it can only go up like 1%, say every 5 years or something, does it get to a point where it's like, okay, you hit 4 or 5% and that's as high?
It cannot go up. Usually it's no more than 5% over the life of the loan.
Okay.
So the lender can't just do anything. There are going to be some limits. So if they say it can only change like 1% each adjustment, it cannot exceed more than 5% over the entire loan. Now, I don't think that's a cumulative situation. Because next year, your loan could go up 1%, but the following year, it could go down 1%, right? So from the beginning, it can't change, it can't be 5% more over the life of the loan, okay? So really a good loan. Think about folks using it.
Are ARMs only under FHA?
No, no.
Oh, okay.
FHA, good question. Andrea said, are ARMs, adjustable rate mortgages, only under FHA? Excellent question, Andrea. No, conventional has adjustable rate loans too. It's just a program they're saying FHA offers. So FHA has fixed programs, and they have graduated, and they have adjustable. All right, discount points, we talked about that, didn't we? What do you think the sentence means? Look at your last sentence under your points, under FHA. Let me find where it starts. Is it a long sentence? Lord, it looks like a long sentence. It is, isn't it? If the seller, so third line down, pays more than the maximum allowed of closing cost, so that would be about 6% also. Normally paid by the buyer, such as discount points, etc. The lender is to treat such payments as sale concession, and the price of the purpose for the loan must be reduced. What does that mean? If the seller pays more than the maximum percent allowed. Now that's a little bit of an oxymoron there, isn't it? Because it said you can only pay up to 6% maybe. If they pay more, well, what happens is if they pay more, the lender will lend less, because they're looking at it as more, they're looking at it as, how can we say this? They're looking at it as a contribution to the loan, really, or to the down payment is what they're looking at. In other words, if the seller is paying $2,000 more, if the lender was going to lend 100, based on 100, they'd only base it on 98. So it'd be a sales concession, sort of like. See if you let me do this. Not the same thing, similar. What if we got two offers on the seller's home? One offer was $102,000 and the seller pays $2,000 in closing cost. And the other offer was $100,000 and they didn't ask the seller to pay closing costs. Aren't they basically the same offer in a way? Isn't the seller still getting $100,000 here? Does that make sense? And so that's what they mean in a way by sales concession. When a property sells, everybody, and closes out, if it's in MLS, this would have to be written in there, because the appraisers search MLS also for sales, sales that have closed out, and they're going to see that as a concession, and they're going to say, well, basically the seller was willing to take $100,000. Does that make sense? Light go on or go off? I don't know which one. It's about the same, isn't it? So that's what they're saying. We'll treat it as a sales concession. In other words, we're not going to lend as much anymore by that amount. Interest rates are negotiable between the lender and the consumer borrower. We know that if the house was built before '78, the lead base paint addendum would have to be attached. Do all houses built before 1978 have lead in the paint? No. Your reading in your environmental said most houses do, not all. And does the seller have to get rid of the lead in the paint?
No.
Does the buyer have to test it?
No.
No. All righty, let's talk about VA loans. Used to call them the GI loan, the GI Bill, a veteran's benefit, or for their unmarried widow or widowers. So VA loans came about after the Depression also, and guaranteed the loan. guarantee to the lender that if the borrower defaults and there just is a deficiency, you'll get your money. So it's kind of an incentive to lenders to lend. The veteran can borrow on mobile homes. They can even borrow on land that they're going to put a mobile home or build on. Down payments are maybe zero even, because 100% loans are available. And the qualifying standards are different than FHA or VA loans. Let's go to the next page. FHA loans, VA like FHA, are not lent by the government. In other words, if you want a VA loan, you would go to a bank who makes VA loans. Now, there is an exception on this. If a veteran lives in an area where there's not a lender that will make a VA loan, the veteran can go to the Veterans Administration and ask for a loan. And so the VA does lend, I would say, I don't know how often, but I would say if there's not availability of a bank in the area, they can seek it from the VA. Now look at your bottom half of page 436. The VA will ask the veteran for their certificate of eligibility. So they're going to be looking at their time in the service, and of course they would have to be honorably discharged if they were. And they're going to look at that in regard to figuring out how much the guarantee will be on this loan. And so they're just giving you an idea about that VA doesn't normally lend money and what the guarantee would be. And they said up to 4 times of their eligibility. Generally speaking, no down payment. Page 437, residential 1 to 4 family dwelling. And they even say that the amount of time could even be spread out longer. They mentioned 40 years. I don't know how common that is, but possibility. There is another certificate that would be required on this loan. It's called a certificate of reasonable value. What's that, everybody? Certificate of reasonable value.
Is it worth what you're paying for?
What now?
Is it worth what you're paying for?
Is it worth what you're paying for, Jose says. Libba, were you saying something?
Appraisal.
It's the appraisal letter. Same thing, isn't it? The appraisal would have to be done by an approved VA appraiser, and so it's like an appraisal letter. Assumption rules, well, we know VA loans are assumable as long as the borrower would qualify. Now, the thing about it is, if the original borrower, the veteran, wants to be released so they can use their VA eligibility again, well, that loan will either not be assumable, or either they would have to find a veteran who will assume it and switch out their eligibility. Does that make sense? So a veteran could come along and assume it, and the original veteran could have their eligibility released and just be switched around. Now, don't get me wrong on this. VA loans don't have to be assumed by veterans. The loan can be assumed by a non-vet, and the thing about it is, the original borrower, their eligibility is going to be tied up, basically, until that loan is paid off. In other words, veterans can use their eligibility more than one time. It's not a one-time thing. Everybody good?
They have to pay it off, right? They
When?
have to pay off the first one to be able to be eligible for the second.
Yes. Now, I know there are some little exceptions to that. If a veteran is using their eligibility right now and they're looking to buy another house and their intention is to sell this one and they want to use it VA again, they might be able to have it temporarily, but generally it's a one at a time type of a loan. Alrighty, prepayment, generally no penalties for that. Discount points can be paid by anybody, and the VA, there is a funding fee that we talked about. Look with me at the top of page 436. if I were you, I think this comparison chart would be a good place to review when you're getting ready to compare these types of loans. So if you'll look at FHA and VA, they have some similarities, don't they? And they have some differences, and both of them are for residential. VA definitely is for GI, or their widows or widowers. FHA insures, VA guarantees. If you'll look at number 8 on the FHA side, it insures the loan, premiums paid by the buyer or the seller. It can be paid in cash or added to the loan. Now the funding fee for the buyer on the VA loan, the funding fee can be added to the loan too, can it? And so, but that wouldn't be like insurance, the funding fee can be added. But if you look at number 10 on VA, the discount points cannot be financed on VA. That's interesting to me. FHA would probably allow that. Why do you think the discount points cannot be financed on a VA loan?
It's already 100% loan.
It's already 100% loan. That's a very excellent point. That might be the answer. I'm sort of thinking it's interest too, isn't it? You're paying, why would we want our vet to pay interest on top of interest? And so VA loans, knowing that little tidbit, if an offer comes in on a listing and the borrower is asking the seller to pay their discount points, that's knowledge you could explain to the seller. They can't add it to their loan. You know, they can add some other closing costs, but not that. Alrighty. Any questions? Let's take our next break and we'll pick up on these other loan types. Take 10.